Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linen Associates with your agriculture update for this sort of quiet trading day. And it was Monday, and it is Monday actually, the 20th of March 2017, just after the 3:17 time frame. All right, as we take a look, you had a late day break in a lot of the grains. In fact, the corn market down even more than I thought. It had lost its embedded reading and gained it right back. Very fascinating move that it's done. Sort of whipsawish back and forth here. Meal still on the downside along with the soybeans. Cotton let go in a big way today, ending one phase of its uptrend. And the sugar market's just absolutely insane with big moves up and down. You got to be careful in that market. Now, as we look at the soybean market, you've still got that 97-cent drop from 1080 to 983, and then just sitting here right now today around 999.5, about unchanged on the day. And that's on the weekly chart, not the day. I said that wrong. The daily chart, the same thing. You're down a half a cent. And as you can see, what the market's done here on just closing basis is 1052 to 998. And you're just sort of drifting right down here on these lows. When we take a look at the daily bar chart, you've got this whole pattern now where you've spent about 6 days going sideways right through here with the overall pattern of one of higher lows, higher highs. So the key is, if you're going to try to establish an uptrend, not to get under 994.25. Should you get under it, you break that pattern. If the market can rally from here, resistance 1018. If it gets under 994.25, where might it go? Well, that could be 986.25, the lower Bollinger Band. So let's understand what I put on charts to just help you. You have the 18-day average of closes in red, the 100-day average. When a market is trading under the 18, I say that it has a downside bias. If the 100-day average were down here, for example, I'd say it was one of the support numbers. But because it is above the 18, it is just another layer of resistance on the chart. In terms of the black Bollinger Bands, keep in the back of your mind that what they are is that they are an algorithm designed to keep the market trading within it 95% of the time. So yes, you can hit it and push it down. It moves with the market to a degree, but staying above it, well, you can do it for not prolonged periods of time, but short thrusts in the market. Getting beyond, say, 4 or 5 days of settling over it, very difficult to maintain. And that often leads to corrections in the market that sometimes come back to that 18-day average, where I call that the line in the sand. It's where the market tries to fight battles to figure out what next. So where are we now? You're in the middle of no man's land. You've got the swing line making higher highs and higher lows, so we'll call the trend up. The bias is down because you're under the 18-day average. When the two fight each other, you have nothing. And momentum, you have an embedded slow stochastic trade, and that rules the day. This is the strongest of my hierarchy of indicators, and until that's lost, you say that the rallies in the market will continue to get sold. When it's lost, the red line will close over 20, and you often look for a challenge of the 18-day average of closes. You'll see that in corn in a moment. In the meal market, you have the embedded reading, so you've got the hierarchy bearish. Unlike the soybean market, you're under the 18-day average. The bias is down, and you have lower highs, lower lows. The trend is down. Where the battleground has been is the 100-day average, and if that can give ground, look for 324.60, the lower Bollinger Band, to be the first support zone tomorrow. In the soybean oil, you're in a corrective mode to the upside. So like the soybean, you've got higher lows, higher highs. The trend is up. The bias is down because you're under the 18-day average of closes. And unlike the soybeans, you're just plain oversold. You don't have both numbers, the K and D, going sideways under 20. Now in the corn market today, I admit, snooker job. You had lost the embedded reading on Friday, and in fact, when you rallied more, you got up into the 25, 26 level. You normally don't re-embed when you get that high. It did. So the trend remains completely down till today's high is taken out. The fact that you lost the embedded reading means this market either immediately follows through and then you'll drop again with that, and that's a good sign. Or if it just hangs here, that's a sign that on any rally you'll lose it again and maybe it'll stay lost. So a market you have to watch. In the wheat market, you have a pattern with the rally overnight of a higher high and a lower low. The market here, and I want to show you, lost the embedded reading on Friday. Here you had it. The day before you had it, and the day before. And with today's action, you gained it back. So just like the corn market, I call it a snooker game because when it got up there, it had every indication it wasn't going to come back and re-embed, but you can see it just fell apart from those highs, went towards the low on the close, in fact, until today's high is taken out. Assume the bears have total control. Now, what did I say about sugar? If you look at sugar last Thursday, you had a moderate day. You were up 2 points, not doing much. You fell apart, got to a low of 1750, and then came running back up into the close, very dramatic fashion. You lost the embedded reading. See the number, the red, number 20.56. You had been embedded, you lost it. Today, you gained it right back with this drop. So this is sort of very much what's going on in the soybean market, the corn, and the wheat markets. All of these markets did that today. And joining the parade where you have the opposite is, well, this isn't the parade. I thought cotton was next. This market is now got higher lows, higher highs. Coffee's saying it wants to go higher. Momentum is pointing up. You're over the 18-day average. The swing line is up. I'm looking for the 147.60 level to be hit. And what you don't want to see is 140.40 taken out, the last swing line low. Cocoa market, also higher lows, higher highs, very overbought, up to the upper Bollinger Band. It is a market that has said 1850, bit too cheap in this market. Can it work higher? It could. And if it does so, the 100-day average is your next layer of resistance, about 100 points higher. As I said in the cotton market, this was a market that was looking actually pretty good. It had higher lows, higher highs coming in. It got up and failed. Complete failure, went right back down, has an outside day down. You have no trend. Momentum is trying to turn down. So is there no trend? No, I'm wrong. 77.33 is the close. Agreed? You have a pattern of lower highs, lower lows, and you're under the 18-day average. The bear trend kicked in today until today's high is taken out of 78.74, and downside target might be the 75.79 level. This market did join into the bear camp. The cattle market's had a problem here against the upper Bollinger Band. It keeps running into that wall, but it does grind higher and it is in an uptrend. The feeder cattle's stronger than the fat, and now it's got, I think, 3 days in a row over the upper Bollinger Band. Today, you definitely had it on Friday. You had it on Thursday. And did we have it this day? Yeah, that's 4 days in a row. 5 is unusual, can happen. The 6th really strong probability it won't happen. So you're in an area where I wouldn't be surprised if you get a bit of profit taking, but you're also embedding on this process, which means the breaks in the market, in plain English, should be shallow, and this pattern will probably develop into a bullish embedded reading. In the hog market fell back to that line in the sand, held it. You're in an uptrend with higher lows, higher highs. Momentum is turned down, so expect a battleground right here for a little bit. And the risk factor would be not to get under right here, the 67.07.5 level. So when I put it all together, I try to come up with ideas for you. And one of them is this April issue of Modern Trader magazine. Now remember, only at March 20th. So you're going to get the April issue. Now, the best I know, we're the only firm offering it now to you, free from them. They've pretty much stopped the other folks. We can do it by email to you. So what you're going to get are 12 issues of Modern Trader, just print it out. It's even got an automatic book. I read mine online, so I'm very comfortable with it. These are the current stories: footprint protocol, currency wars, platinum gold spread, trading winner with the Minnesota squeeze, not Monsanto, ETFs, you're going to get derivative trades, all the like. Their stories are great. The pictures, the graphs, absolutely first rate. And there's something for everybody. Then to go along with it, you get daily market focus. With these are the stories of the day. Like today, we were spending all day with the House Intelligence Committee. There'll be a lot of stories about that tomorrow. Call us. Go to our website. You'll see a carousel of free offers. Click right up here as well. If you're watching me on YouTube, the form will appear there. Or under us on many websites, there's a word that says click here. The form will take you right there as well. So it's pretty simple to do. I'm Ira. Thanks for watching, and I'll see you tomorrow.